Hello, everybody. Welcome in. Welcome to the show. It's Friday, and it's time for Bitcoin and macro, crypto, whatever you want to call it. There's a lot of stuff going on out there, and it is very interesting. What I'm going to do is take us on a global tour of the world from a macroeconomic perspective. I'll show you some interesting things that tie everything, of course, ties into crypto and macro. It's all connected, and let's jump in. So hope everybody's well. And of course, you can see here that Bitcoin has been very flat for quite some time now. It hasn't really done much. Thank you, Lex. But weekends are where the action happens. So let's jump in. Thanks all again for coming, and thanks to the mods in the chat too. So this is called macro mixed signals, and of course, it doesn't matter. Not investment advice, mostly macro anyway. But there's some really cool news too. Don't forget to subscribe to the channel too. And this is not just all macro for those who just want GRQ from BTC, but it's a tour of the planet. And I'm going to show some things actually will be quite surprising about the countries where you may live, whether it's North Korea or Germany or the UK or US or whatever else. And remember, even though a lot of the data I show will be American, it's the same all over the world. Now, first, a lot of people were expecting the spot ETF to happen today. Well, we weren't, but the SEC, some good news is they have been discussing with stock exchanges the possibility of introducing the spot ETF, which is good. They've also suggested using cash for investments instead of exchanging it with Bitcoin or other assets. And this requires some adjustments on the back end of everything else. So the good news is the SEC is talking to players, and they are laying the groundwork for the spot ETF. So that's coming. Just we don't know when. I still reckon January 2024. So don't be disappointed. It's more time to stack. And wouldn't it be glorious to see a 35K Bitcoin again? Let's see. Also, another interesting news as well. You can see here Bitcoin fees are skyrocketing on the ETF hype. They have literally blown off ever since the ordinals back in April 2023. You can see here we're at the second biggest high of the year, and that is great for the miners. But there's also some interesting stuff happening with miners too. Let's dig into that after we talk about spot Bitcoin volume. You can see Bitcoin spot volume is back, the highest level since January 2021, which is a hell of a long time ago. It may seem like yesterday, but it's not. So the volume is good and back, and that's the largest monthly increase since January 2021, not the largest amount of volume. Make sure I got that correct. Also, Bitcoin bulls are extremely bullish. The notional value of options on Deribit, the leading crypto options exchange, hit a record high of about 15 billion earlier in the week, surpassing the previous all-time high of 14.4 billion, again from October 2021. And that's just before Bitcoin reached its peak price. And this is why it's so interesting to look at this. Remember, wrong camera, turn that off. What am I doing? What's screwing up here? So when I keep saying that things are happening earlier and faster this year, last time this happened was right before Bitcoin hit a new all-time high. We're nowhere near an all-time high. That's why this time is so different. In addition, Strike enables checkout.com in 65 countries. The crypto app announced a big partnership. Again, baby steps towards global adoption of Bitcoin is what we like here. Jack Mallers is amazing. He's got partnerships already with Shopify, I think, a bunch of other players as well. So check out the app. It's really cool. Now, another great Bitcoin news too, and this ties into the mining stuff I shared a minute ago. Tether, they are a money printer, and they are going headlong into Bitcoin mining. But of course, remember, the mining space is already crowded, but it's getting red hot and also hyper competitive. Now, the good thing for Tether is they literally do print a lot of money. They have decided to invest $500 million in establishing their own Bitcoin mining operations. And they are playing in places like Uruguay, Paraguay, El Salvador. Get it? Guess why? Because power is cheap in those places. And they want to be able to get to a position of maybe ultimately being a leader. They have a couple of facilities that could generate between 70 or 50 and 70 megawatts of power. And, they don't want to be a massive player out of the gate. Hey, Mike, good to see you. But they want to gradually be a massive player. Now, this is on top of what they're also doing beyond mining. They are investing 15% of their profits into Bitcoin holdings, and Bitcoin holdings are now represent a big part of their bag. They are profitable like crazy, so this is all really good news. This is like not like a government money printer, but similar, and literally I think the market cap now of Tether is about 87 billion, and that's massive, and they are literally printing money. They're making 5% on that 87 billion. Now, this brings me to this chart here. Shout out to Seb for this one. What's interesting about this is it shows you all the public miners and how their share of hash has decreased across the board. Everybody from TeraWolf to Argo and everything else in between. Some players like Mara have lost a big chunk, and others too. And you can see the percentages there. The key is, what is going on? So all these big public miners are buying rigs like they're going out of fashion. They're plugging them in, they're expanding their hash, but they're still losing hash. This tells me that either a nation state or multiple nation states or big private companies like Tether are setting up their own mining operations. It's the race for Bitcoin. I always said mining is a cutthroat business. It's about to get a lot more cutthroat too. So watch this space carefully. Now, why do people care about Bitcoin? Well, this is a beautiful chart. Shout out to Sanjay as well. This is the consumer price index. A lot of talk about inflation and debasement and everything else. And of course, it's all tied together. And this is tied to what we're going to talk about in a minute regarding treasuries. This is a reminder of why we Bitcoin, because CPI is going to the roof and it will continue to do so despite the fact that some data says it's not. And we'll see where it's going. So the question is, if costs are going up like that in your dollar, it's a big, fat, melting ice cube, ladies and gentlemen. Now, this is also huge news today that you may have missed. It just kind of broke a few hours ago, or even after that. There's a proposal in Germany to make Bitcoin legal tender. This is Joanna Couture. She's a member of the German Bundestag. And also I think she's part of the Alternative for Germany, the AfD party in Germany. And they have proposed groundbreaking legislation to make Bitcoin a legal form of currency in Germany. And this would require businesses and individuals to accept Bitcoin as a valid form of payment alongside the euro, just like in El Salvador, although it's the dollar in El Salvador, not the euro. Now, what's interesting about this is kind of crazy, but I think in the proposal, they want to help address risks of things like money laundering, tax evasion, and other unlawful activities. Interesting. So having Bitcoin accepted as legal tender could perhaps prevent unlawful activities in fiat currencies. That's an interesting angle. So we'll see where this goes. Of course, Bitcoin didn't really pop on this at all. It's still kind of, let me check where it is right now. It's still kind of stable, not really going anywhere. I think last time I checked. Hold on a second. Too many windows open as usual. 36,500. It did a little bit of pop, but it's literally bouncing around this whole level all day of 36,400. Doesn't really do much. So I thought that would have blown the things off. And again, in government, things can be proposed. Most stuff probably never flies, but shout out to Germany because they do have some struggles. We'll talk about them in a minute too. I did tell you it's the German tour. Now, what I've also noticed is there's a lot of crypto names getting into central bank digital currencies because they can't drive adoption any other way. And also government entities. They are now referring to CBDCs as different stuff. Now they call it cash replacement. Well, there's no doubt CBDCs are coming, but they're beginning to refer to them as a different name to confuse you. But just share the benefits of how it's going to save you time and money, and it's going to be great, and it'll offer resilience and everything else. This is the IMF MD, Managing Director, Kristalina Georgieva. I think she is from Sofia in Bulgarian. I could be wrong on that. But they have a plan for you, and they want CBDCs as quickly as possible. And remember, IMF is in bed with central bankers, you name it, all around the world. So they all talk together. So it's coming. Prepare yourselves. It's going to be bad. Now, Friday fun quiz time. I want you all to drop a quick comment below. Which one represents the IMF the best? It's a bit of a quiz, okay? I do actually have the answer. We have dark blue, orange, green, light green, blue and brown. No, light blue and brown. So, or you could do 1, 2, 3, 4, 5. Let me know what you think, which one represents the IMF and the central bankers and the greed and everything else, because there is a specific answer. Now, speaking of the Fed and money printers and greed and why I do these videos, this isn't some rando crypto coin, meme stock, junk bond, or third world country currency. It's the losses at the Fed over the last year and a half. And these are the people with a money printer, and they somehow managed to lose billions and billions of dollars. This is right now losses over $120 billion just in the last year and a half. Pretty stunning. How do they do that? I don't know. Amazing. Now, another little bit of good news. This is from our friends at Econometrics, and they are looking at the NFCI credit index. And I always say when credit dries up, the economy grounds to a halt. But the good news is, per this chart, QT is already fading away. The credit index is now back near 2022 levels. And this is signs that the QT that we were all afraid of, quantitative tightening, is now beginning to fade. And we've seen this with things like the BTFP program. There is money coming into the system. You won't see it directly, but the big banks and other players do out there. So again, good news for 2024. It's going to be a bonkers year. But I got more good news too. This is only good news if you're in these names. But US equity concentration is at a record level. This is the S&P 500 index. Weight of just the top 5 stocks, not the enormous 8 that I now refer to. The top 5 stocks in the S&P now account for 25% of the entire index. And meanwhile, these same 5 stocks currently account for 75% of the Nasdaq's gains this year. Just 5 stocks, 75%. And technology stocks now reflect a record 26% of all equity fund assets. And just 8 years ago, it was 9%. Absolutely bonkers, everybody, how things are actually changing. Let me do one thing. Hold on, I'm trying to do something new, and I can't. Anyway, not to worry. I was trying to do trying to figure out how to make a little like thing. So if you like this content, if you're learning something new, hit the like. That's all I ask. Now, this is also good news. I've been expecting a big year-end rally, but there's a ton of cash now moving into stocks. There was a tiny little dip in early 2023, I think it was Feb 20, a tiny dip. You can't even see it on the chart, so we're just going to ignore that. But look now, there is outflow from treasury funds. Nobody wants their treasuries now. Now they want to YOLO into the stock market, and because they believe they can get better returns there, even with 5% guaranteed from the actual treasuries itself. And this is crazy. This is the biggest outflow since, I think, August 2022. And again, it's setting up for a nice year-end rally. Remember, there's $5 trillion on the sidelines. It's beginning to come out of treasuries now, and it will be deployed into stocks. There's nowhere else to put it. Nobody else is buying bonds. Speaking of people getting hosed, I remember it was back in summer 2023. Everybody was freaking out about Michael Burry. He basically got into one position, and that was to short the Nasdaq and short the S&P 500. Well, Michael Burry got buried. He lost at least, per Gergovin, 40% of his fund on that bet. So, sorry about that, Michael Burry. You were right 23 years ago. Let me see. No. 13, 14 years ago with the Big Short. But since then, your record has been a little bit off. Anyway, much respect. In addition, news, which could be another tailwind for stocks too, is 30% now believe the rate cut will happen by March 2024. This has come forward. This is supposed to be kind of July, August 2024 timeframe. Now 30% believe it'll happen. The first cut will happen in March. And remember, March is not that far away, and it could happen even a lot sooner. So this will be another tailwind for 2024 when these cuts happen. Now, let's talk about a bit bit more macro news. This is CPI of all items less shelter. And you can see it's under that middle line, the black line there of 0. What this means is deflation, and deflation is the kiss of death to any economy, especially an economy riddled with debt. I've covered that many times, so I won't go into it here. But the point here is the CPI data reveals two crucial insights. Obviously, we are technically, if you pull out shelter, the cost of real estate and homes and rent and everything else, we are deflationary. That is bad. That's probably why Jerome Powell said, shut the bleep bleep door a few days ago, because he can see this, and this is concerning. Now, if inflation does go, or for real estate, the inflation on real estate shelter does go negative, we're in trouble. But again, these numbers are very contrived. Let's have a quick look at what this actually looks like. Another view. This is based on the October CPI and PPI, and forecasters expect the core PCE index. It only rose 0.17, I think, in October, and it would mean the last 6 months since April, May, inflation was only 2.4%. They're looking for that magical 2%, but that's only on a 6-month basis. And even if you pull out housing, the forecast is like 0.15%. So again, we are deflationary per this data, but you can't really trust all the data. Now, speaking of prices falling, oil is also in a bear market. It just took a huge 20% haircut, down from 95. And this is despite the fact that OPEC are tightening production, but the US is increasing production fast. It's a very bad political sign to have expensive gas prices for voters. So maybe part of the reason the US production is so high now is to bring that price down. Speaking of other deflationary stuff, there's heavy, this is what they call deep sea water transportation. This is kind of the big cargo ships with those big boxes stacked. This is the biggest plunge in the history of tracking this data. Okay, this is a near 12% plunge in October, the largest ever, ladies and gentlemen. And that means the economy is slowing because nobody's shipping stuff. So there's lots of excess capacity, which is driving prices down, and is more ugliness as well. That's why many believe there is a potential for a recession in 2024. I believe it's already happening or has happened. Now, not all things are deflationary though, however. Hedge funds are being smashed. This is orange prices, orange juice prices, and they surged to a new all-time high, up 240% since 2021. There is no hedge fund that I know of anywhere that has had results like orange juice. So for those who think there's not money to be made anymore in the markets, well, there's always money to be made. You just need to know where to look. And in full disclosure, I've never traded orange juice, but it shows you interesting one. Now, home costs, back to real estate, they are hurting the most. This is the principal and interest. Sorry about that thunder in the background. This is principal and interest of the median home, and it is up nearly 120% since 2021. This is what's hurting the most. Gasoline is up about 42%. And then you see groceries about 22%. They completely flatlined all year. Although, if you go to the store, you may not believe that. Your owner's equivalent rent and CPI are the same. So they've also kind of flatlined. So that's kind of where we are from a CPI basis. But the point is, the Fed has zero reason to ever raise, and that's why they're probably going to drop in March or earlier, because they're losing a ton of money themselves as well. Now, home buying conditions, sadly, are the worst since the 80s for people out there who are thinking about buying their new home. It's hard. There's an interesting story from a fellow called Brian McCusker. He attests to the fact that I think a story something like, gasoline and food don't scare me. I'll go out to eat less. I'll buy a moped, etc. Housing is the one thing, however, a lot of people view as the American dream. And the first house proves a lot about you as an American adult. So this guy, Brian, is 33, and it bothers him because he has a master's degree in school counseling with a concentration in children and family-based therapy. And he's back at home living with his parents. Sir Winston, thank you so much. This is how difficult it is out there. This is the damage the Fed is doing. They made it impossible for people to make payments. They're getting smashed by credit card debt. and literally can't afford to buy a home. In fact, in California, home prices went up 5% because nobody's selling. There's no demand, but whatever demand there is, people just need to buy it no matter what. So that's just the crazy, crazy situation of how this time is different. Now, the other question is, other than California, at least California is one bit of good news, people, maybe, just guessing here, they are buying Bitcoin instead of real estate. Now, if you look at the S&P 500, this is the chart of the S&P 500 real estate sector. You can see it's the lowest ever. It is now 4.88% of the total S&P index. And the average of this is normally north of 8 or 9%. And now it's nearly half of that. So real estate is getting smashed. I've always warned people against buying REITs and all that type of stuff. There you go. Results years later. Now, speaking of soft landing as well, shout out to James Lavish, guest on the channel here. He tweeted this in a quick search for soft landing stories on Bloomberg Terminal this morning. Here's the first page. Tons of stories about soft landing. Now, in my experience, when everybody expects something to happen, the opposite happens. That's just the nature of markets. That's why you have to be a contrarian. You have to be against the herd. If everybody expects a soft landing, it's simply not going to happen. And this is a proof point of that too. Now, back to US Treasuries, which is an alternative to things like stock market and Bitcoin and etc. But here, Bye UST, foreign flows of US Treasuries are now negative. China continued to dump them as quickly as they can. In fact, they accelerated over the last 2 months. Other central banks, again, are buying a fraction of what they used to buy. And private investors are dumping money there. But that's the interesting thing. I just told you over the last week or so, they started leaving their treasuries outflow into the stock market. See how it's all connected? Expect more of that too. And the US government is flooding the market with treasuries because they're printing so much money and the debt is exploding by 2.4 trillion over the last couple of months, and the rest is history. Now, take these US treasuries and stuff them. This is Japan, a deep little focus here. Foreigners used to have an insatiable appetite for US government debt, and now they don't. And that's bad news for Washington. The US Treasury market is in the midst of a major supply and demand change. Federal Reserve is shedding its portfolio at a rate of about 60 billion a month, and overseas buyers who are once important demand, China and Japan in particular, don't want it anymore. They're not buying it anymore. And the US Treasury has issued that 2.4 trillion in new debt this year. And again, issuance is way up. Foreign demand has dried up. It's a mess. Who's going to buy these things? And that could cause a problem, because the only way you can attract people to buy these things is to pay a higher coupon rate. But they can't afford that. So let's move on. Let's go over to Europe for a second and look at some comparisons here. This is the 10-year minus the inflation spread, the real yield, which is the nominal yield of a bond minus the expected inflation rate. And this measure gives investors the idea of actually purchasing power, increasing in their bond investments over time. The truth is they don't. But anyway, here's what the chart indicates for each country. You can see here Italy is showing a significant high real yield, suggesting that investors buying Italian 10-year government bonds can expect a higher return above inflation, albeit we'll see where that goes. Now, the US has the next highest real yield, although it's less than half, a good bit less than Italy's, half a percentage point. And UK and Germany are showing lower real yields, with Germany's at about just less than 0.5%. And this suggests that returns investors can expect from these bonds after adjusting for inflation in Germany are much lower and almost negligible. Really not worth it. And Japan is also showing a negative real yield, indicating that the nominal yield in Japanese government bonds is lower than the expected rate of inflation, which means investors are getting screwed. But that's really what happens over bonds. And that's why Bitcoin is popular. They don't want this anymore. Anything tied to fiat is just going to die a horrible death. Now, Germany. This is German bonds, basically, versus Italian bonds. And you can see how risk sensitive they are. This is from Holger Schepitz. And this is the ECB QT underway, like a little bit in the US, but slowing down. but markets have become much more sensitive to Italy risks, despite the fact that Italy is actually growing faster than Germany. And the 10-year risk premium over German bonds has jumped up to 200%. So this is kind of an interesting quandary. So Italy is growing faster than Germany. Germany used to be the powerhouse, but Italian bonds are riskier. Let's have a look. This is kind of a bit of a conundrum. Let's look at Germany, for example, compared to some other European countries. This is a graph showing the season-adjusted GDP growth in 2023 for the largest economies in Europe. And the GDP growth is measured as a percentage change from the previous quarter. And it shows you that the German economy has stagnated, and with a GDP growth of basically zero. And this is the first time that this has happened since the fourth quarter of 2020, I think. And also the other areas, if you look at Q2 over Q1, you can see that, let me see, France doing good, Spain doing good, Netherlands getting hurt, and the whole Europe on average is up a fraction. But this is kind of interesting because the stagnation of the German economy, the biggest economy in Europe, is a huge concern. Okay, because it drives growth in many other players around Europe. So where this is all going to go, I'm not sure. Now, maybe as well, part of the reason for German weakness is there's been a double-digit drop in German exports to China, and this has rattled Germany as well, especially the car industry and the heavy manufacturing industry, triggering a debate over why its vast manufacturing sector has fallen behind rivals and the rebound in Chinese demand. And this huge is 11.3% drop, I think, in German exports to China in the first 4 months of the year compared to the same previous year. Car makers are losing a huge share in Germany. In fact, car makers are beginning to pull out, and they are being smashed by a company. Well, they're being smashed by two things. One, the EV revolution, and also Tesla. And now they're simply not buying Audis and Volkswagens like they used to in the past, Mercedes. And that's a big problem for Germany, perhaps. Now, there's another funny thing going on here, which is similar to the US. Germany has entered a recession as GDP is flat or shrinking, and we still have full employment. This is interesting. The country's unemployment rate has remained stable at 5.7%, and it's another paradoxical situation. Again, maybe in Germany they do what they do in the US, and most people have 3 jobs or whatever. Who knows? We'll see. But that is another paradox. Now, a little bit of sad news for the team in the UK that are out there, and I hate sharing bad news, but this came from Bloomberg, and the source is Eurostat. And I'm not sure what's going on here, but you can see here the UK is in blue, and clearly that British wealth is not rising as fast as its European peers. You can see Denmark off the charts, probably due to Wegovy, the weight loss drug. The next in the box is Sweden. Flattened though, but was up a lot over the last, call it 25 years. And then next is Ireland, third spot, growing very fast. And then Netherlands, which we just saw, is having some troubles. And on and on. So who knows where all this is going, but Germany is also no longer the powerhouse, being led by the big 3 of Denmark, Sweden, and others. So I hope this data is very wrong. And actually, let's look at this line one more time for Britain. It looks like it is rebounding. It's ticking up a little bit, but maybe it was also hit a little bit. Who knows? We'll see. But we'll watch this carefully. And final piece of news. This is a cool little chart I tweeted out the other day. And that is me on Twitter. Mastering poverty. It's very sad to see. This is the per capita GDP in North Korea versus South Korea. North Korea is the dead flat red line at the bottom, and South Korea is the blue line going up and to the right. Huge. The average GDP per capita is about $1,000 in North Korea versus $20,000 in South Korea. And this is the Authoritarian Guide to Staying Poor. Markets work best when they are free. That's it. It's not hard, but the more governments try and control stuff, the more things break. So with that, everybody, thank you so much. Everybody on Patreon, Hope everybody's doing good. Have a great week. And Bitcoin sometimes pumps on a Friday. Let's do a quick check-in on where we are. $36,520. It's $120 what it's been over the last 24 hours. Thank you all for coming. Hit the like on the way out. And thank you to the mods in the chat and everybody else. Love you all. I'll see you tomorrow for the weekend recap. Let me know, by the way, if you can figure out whose belly is the IMF. Thanks all.